Okay, Chair, the floor is yours.
Okay, thank you. This is the regularly scheduled meeting of the Citizens Oversight Committee of the City of Morro Bay, acting as the Citizens Finance Advisory Committee. It is Tuesday, January 19th, 2021, a little bit after 3 p.m. And let's do a roll call to see who's here. Homer Alexander.
Present.
Bart Beckman.
Present.
Lois Johnson.
Present.
Barbara Spagnola.
Present.
Tina Winner.
Present.
Stephen Peck.
Present.
And John Martin, I'm present. So all 7 present. And I would like to extend a welcome to Stephen Peck. Thank you for joining our committee.
Thank you for letting me join you.
Is there anything you'd like to just say about yourself in way of introduction?
Sure. Most of you know me from my chamber involvement. I was chair of the chamber last year and involved in the Governmental Affairs Committee. My wife and I have lived here full-time for about 5 years now. I've had a home for about 15 years. Kind of a typical story of a lot of folks. Prior to that, I was a consultant in a planning and engineering firm for almost 25 years, and also, in addition to that, worked for the city of Visalia as a planning director and redevelopment director for them. So some of the government processes and requirements I'm fairly familiar with, and as part of my consulting practice, I worked pretty closely with cities and counties. I worked with the interim finance director when she was at San Luis Obispo, so good to reconnect with her and reconnect with all of you. So thank you for letting me join you.
Well, it's entirely our pleasure. Thank you, Stephen. And do you prefer Stephen, or is there a shorter?
You know, my wife calls me Stephen when she's angry with me, so I prefer Steve, if that's okay.
Okay, all right. Steve, thank you. And welcome. So are there any other committee member announcements? Okay, hearing none, then we'll move on to public comments. This is the time set aside for items within the subject matter jurisdiction of this committee that are not on the agenda, or if they're for items that are on the agenda, you can speak to those now if you can't wait until that item comes up, or preferably wait until that item comes up and then make your comments at that time. Zeke, do we have any public who would like to make comments at this time?
Chair Martin, at this time, nobody in the queue has their hands raised.
Okay, thank you. All right, so we'll move on to the first agenda item, the consent calendar, approval of the minutes for the December 15th, 2020 CFAC meeting. Does anybody have any changes or questions about minutes?
I do.
Okay, hold on.
Section C, future agenda items. Number 2, dash number 3. I believe it should read legality of the general fund and harbor fund.
Okay. And who's taking minutes for us today? Dana?
Tracy is taking minutes today.
Oh, Tracy is, okay.
Yeah.
So hopefully Tracy got that. Any others? Changes? No? Okay, so can we have a motion to approve the minutes as amended?
Also move Spagnola.
Okay. And a second?
I'll second. This is Lois.
Lois, okay. All those in favor?
All right.
Aye.
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 Any opposed? Okay, the motion carries 7-0. Thank you. Okay, so now the first business item, review of the fiscal year 1920 Draft Comprehensive Annual Financial Report. And I'll turn this over to Katie. Katie, you need to unmute.
Out of practice, sorry.
Thank you.
Yep. It's our pleasure to present to you the Comprehensive Annual Financial Report. Today we have with us both the principal or partner at the Poon Group, hopefully, who I do not see yet on the...
I see Catherine Choi.
Yeah. But so far, I don't see Vanessa on here. So they have a presentation to make. It's the first time that they've attended the CFAC meeting to make this presentation. It seems appropriate to me, given their role in the audit. It looks like Vanessa just joined us. And so it'll be Vanessa providing you with the bulk of the presentation. We're happy to provide any details that we can provide on the portions that are management driven, such as the MD&A and the transmittal letter. Vanessa, Sandy, myself, and Catherine have discussed the changes that were identified as part of responding to the questions, and we're happy to walk through as many of those as we need to. There were, I think, in total about just a little under 30 questions. There were one or two that were responded to directly to the individual who presented them because either there was not enough time to incorporate them, and I'm happy to share those questions with the rest of the group, or they seemed like they were very specific to the interests of the individual member who was asking them. So on that note, I will turn it over to Vanessa. I'm going to share my screen so that Vanessa can continue to look at the screen, the gallery screen with all the pictures on it. So I will not be able to see any of the pictures of your beautiful smiling faces. So if anybody needs anything from me, like to move the slide, please just let me know. And I will put us into screen sharing mode, hopefully.
I think I may lose my gallery view as well.
I don't think you will, actually.
Will I?
It'll be on the side and then you can expand it.
Yeah, and I have one on my side up already too.
Yeah.
Well, while she's getting that pulled up, good afternoon, Chairman, members of the committee, and I know I've met Sandra and Katie. So far, I do have with me our audit manager, Kathy Choi. I am new to the engagement this year. I think Ken Poon has presented previously to you in other years, and so I'm pleased to be here today. And I was happy to see the number of questions on the report. Many times we come to city council meetings and we get not a single question. So I appreciate everybody. Oh, and you know what, Katie, on that slide deck, you have to turn off the timed slides. So if you go escape out. In our template, it's time to go to transitions, and then actually go to go to home. I already took it off on mine. Go to review slideshow. Use timings. Turn that off right under there. Right. So under setup, next one to your right. To the right. Nope, cancel that. Sorry. I was thinking I was going to share mine, so I took it off mine. Go to slideshow. There. Take right to the bottom right of where you're at. Keep going to the right. move over. Use timings up at the tippy top. See that plane area?
Yes, I apologize.
Turn that off. Yeah, there you go. Now you can do full screen. Sorry about that.
Yeah.
For some reason, our template has timing set up in it, pages, and I've been through enough of these where we forget to take them off and it just keeps circling and then I have to back up. So anyway, it is my first year on the audit this year. I know you've been a client of ours for many, many years, so I appreciate the opportunity to come and present. I am a partner with the Poon Group. I reside in our Walnut Creek office. I actually manage, oh, that's weird. I did it not did it not save it?
Keep going. It might have been user error on my part.
Oh, okay. So I manage our Northern California region as well as our Arizona office and region there. I've been in public accounting over 30 years now, and spent most of my career in public sector, serving public sector either as an auditor or as Katie and I have talked about on their side as a director of finance. You all may know the story of City of Stockton and its municipal bankruptcy. I was the chief financial officer that helped take them through their municipal bankruptcy. So have had experience on the inside in some distressed municipalities. I worked on San Bernardino's as a consultant, and then worked as an interim finance director for another small city in the Central Valley. So pleased to go through what I have in front of you. And I don't know if this has been your typical pattern in the past, but I usually do a brief presentation on the CAFR, though you've had it for some time. This will kind of summarize the data, open up conversation at the end, and then I can address any of the questions that I know you just got the responses to those, but I can address any of those either at this meeting at the end or at any time. So go ahead, Katie, to the next slide. So this is essentially the committee presentation, and this would be the same type of presentation unless we need it scaled down some from this for council. It depends generally on how much time I have allotted. And for the pleasure of the committee, how much time do I have allotted for presenting today with your agenda?
Well, I was hoping to get out of here completely in 2 hours. So
Okay.
What do you think, Katie? Half hour total?
For the item, Mr. Chairman?
Well, for the presentation, I would.
Oh, yeah. I was thinking, given the scope of the questions and not knowing if we've done a sufficient job, if you could keep it to 20 minutes.
Absolutely.
Okay.
Okay, so typically what I like to do is go through what our scope of work is for the city, just kind of as a reminder. We talk about audit responsibilities as it relates to the CAFR itself. I'll give a brief overview of kind of highlights of the financial statements in more of a condensed format. We'll talk about financial indicators and key pension information. I'll give the final, audit results, and then, thank you and open it up to questions. Next slide. Next slide. So our scope of work for City of Morro Bay is essentially to perform the financial audit of the comprehensive annual financial statement. And this is a single year presentation, which is June 30th of 2020. The MD&A will have comparative financial information in it, and we were the auditors for 2019. So we're familiar with that. And so obviously there were some questions on the MD&A, and we can address those. The other area we have is the compliance audit, and that is an audit of the TDA funds for June 30th of 2020. That includes the local transportation fund for roads, the transit enterprise fund, and the local transportation fund, non-transit, and the bike path. And though that compliance audit itself is in progress. And so that's what you have in front of you today. In addition, in your packet, you should have received a separate letter from us, which is our annual required communications. I have a slide that goes over that. And that is our required communications under our operating standards, which is the American Institute of Certified Public Accountants. And the code section on that is AUC 260, but it used to be our what we would call our SAS 114 letter. So we've included that in the packet and the agenda on those areas that we are required to communicate annually to either an audit or a finance committee, as well as the board or a city council, essentially what's deemed to be those charged with governance. Next slide. So let's talk a little bit about audit responsibilities. So essentially, you've got a very large packet with a very large document in it. And when I talk about management's responsibility as compared to our responsibility, they have a heavy lift because that whole document, except for the 2 to 3 pages, that is our audit opinion, is essentially their responsibility. Management extends to those charged with governance. And essentially what that entails is ensuring that the city itself is presenting the financial statements in accordance with generally accepted accounting principles adopted in the United States. Those standards are issued by our standard setting body, which is the Governmental Accounting Standards Board. And so they issue a statement of standards, and I'll talk about one of them later in the presentation that was adopted in this year as a result of COVID and its impact to this presentation. But essentially, management is responsible for understanding and implementing all of those standards that get issued by GASB. In addition, the responsibility is to adopt sound accounting policies, which means those that are acceptable in the industry and consistent with those standards, and as well establish and maintain internal controls over financial reporting and compliance. You do have compliance. We talked about the TDA. So that means that internally you have to have sufficient internal controls over that financial statement, financial reporting to your external users. Lastly, they provide evidence supporting the amounts and disclosures in the financial statements. That evidence gets submitted as part of the audit on an annual basis. Many documents get passed back and forth between us. This year was an unusual year. I'll talk a little bit about COVID, that the whole audit was done remotely, whereas in past years, that documentation, we're able just to walk into Sandy's office and she could pull it out of her drawer and hand it to us. So there was a much heavier lift, I think, this year on the audit by your team to get us everything in an electronic format. And again, that's part of the really the response to COVID and its impact to not only your workforce, but ours as well, and how we're looking at doing audits in the future. Last is your internal controls should be set such that it allows you to prevent and detect fraud if it were to occur within the organization. And I like to say material fraud, meaning that it was material to the financial statements. That doesn't mean that you shouldn't have policies and procedures in place for fraud that wouldn't rise to a material level, but it just wouldn't bubble up in the audit for purposes of the audit of the CAFR. Next slide. So our responsibility as it pertains to the 2 pages 1, 2, and 3 of the report is that we are required to perform the audit in conformance with auditing standards generally accepted in the United States of America. Those standards are issued by our policy setting body, which is the AICPA, as well, since you're a governmental entity. Those standards that are applicable to financial audits that are contained in what we would call our government auditing standards. That's the street name for that is the Yellow Book. The GAO office issues the Yellow Book, and we are operating under the 2018 Yellow Book for purposes of this audit. Our other responsibility is to have these meetings, ensure that we are communicating with those charged with governance, and that communication is two-way, meaning you're asking questions and we're responding, and we're presenting data and also asking questions of you. We are responsible for assessing audit risk of your internal controls over financial reporting and compliance, ensuring that that risk of internal control is at an acceptable level for purposes of preparing the financial statements free of material error. Second and third bullet is we determine the fair presentation of the financial statements and looking at fairness in accordance with those standards. And then lastly, rendering our audit opinion on the financial statements. Next slide. So I'm going to go over when we talk about the CAFR, and I think this will be important as we talk about the questions towards the end of the presentation. What you have in the very, multi-hundred-page book is a comprehensive annual financial report. A CAFR is not required under the GASB standards, but you take your financial reporting to a higher level, which means that you are submitting to the GFOA your audited financial statements, which is a CAFR. For purposes of winning an award of excellence in financial reporting. And that is kind of the gold standard to say if you've met the GFOA requirements, they issue you the award and you get to include it in your document. So that CAFR is broke down into several sections: introductory section, financial section, and on the next slide it'll be statistical, but you don't have to turn there yet. I just have it memorized. And really, if you were not submitting to GFOA, you would only see this financial section as is described here. That is what is required by the Governmental Accounting Standards Board. Everything else is extra, and you're going above and beyond to present that information. And then even within the financial section, you can see there are several components, which is our independent auditor's report, our portion of that document, the required supplementary information, which is management's discussion and analysis of that financial statement. And you'll see that's notated as unaudited. The basic financial statements, the required supplementary information, meaning required by the standard setters, that is also unaudited information. And then supplementary information, which management decides it is not required and it is added for purposes of additional information. And we only apply limited procedures to that. So when you actually look at that, the bulk of the book starts between basic, required, and supplemental, but management's discussion and analysis, which is required supplementary information and is unaudited, is really what I would say is the lay version and tells the story. It's a story provided by management of all of the wealth of information that's in there related to the city's financial status. And so if you were to read anything, I would always read the management's discussion and analysis if you didn't want to read the whole book. The required supplementary information includes budget comparison information, and then more notably is your pension and your OPEB, and we'll have a couple slides on that. Next slide. Statistical section is also unaudited. It provides financial trend, revenue, debt, demographic, and other operating information. We do look at this information and compare it back to the financial statements just to ensure that there's no major inconsistencies, but it is unaudited, and it varies by organization as to the type of information that's presented in here. But typically it provides trend information, which is useful in evaluating the government's ability to meet its budget, to meet its obligations, and is good, useful information. Next slide. So what I'll do is I will walk through in your book, and I don't know if you need me to refer to any of the pages, but if you turn to the basic financial statements, there's essentially your government-wide financial statement and then your fund statements. And there are two different sections, and we will focus our presentation here on government-wide and the general fund. And there's a reason for that. So when you take a look at overall the City of Morro Bay's government-wide statement of net position as of June 30th of 2020, you can see that your total assets are $196.7 million. Total liabilities are $41.7 million, and your ending net position is $161.3 million. I left out the deferred outflow and inflow because those are pension and OPEB related numbers of $8.8 million, a deferred outflow of resources, and a deferred inflow of resources of $2.5 million. And then what I'd like to focus on is if you look at governmental activities as opposed to business type activities, you can see your governmental activities net position is $113.1 million. Your business type activities are $48.2 million, comprising the total of $161.3 million. Business type activities are those activities where there is a user charge involved and you're recovering costs of doing business, such as for water, wastewater, et cetera, harbor, whereas your governmental activities are more those activities that are supported by taxes, not less by fees, and are really kind of all the other that can be classified as business type activities are not operating necessarily in that fashion. So typically we see in the governmental activities, this is where your police and your public works, all the public safety activities will be here. Your special revenue funds, as well as your internal service funds, do get rolled up into these numbers. Although on the fund statements, they're in the enterprise fund activities, it gets rolled up into the governmental activities. So overall, in your governmental activities, of those total assets of $136.3 million and deferred outflows offset by liabilities and deferred inflows, you can see your first line of net position is your net investment in capital assets. So that's capital assets less any related debt that is unspent at the end of the day. And those are typically your illiquid assets. You wouldn't normally as an organization go and sell your capital assets necessarily. The next is your restricted assets, $6.4 million, and that is restricted by either law or regulation. It isn't internally restricted funds. It is restricted by an outside source, and that's $6.4 million. That leaves you with an unrestricted deficit in your governmental activities of $10.2 million. Again, the majority of that $10.2 million is when we placed when GASB required full accrual financial statements to include the pension and the OPEB liabilities. Many cities saw a very large unrestricted deficit to be funded over time in the governmental activities section. Business type activities, $60.4 million, offset by your liabilities and your net deferred inflow and outflows, leaves you with capital investment and capital asset of $38.3 million. There are no restricted funds, and that in the business type activities, leaving an unrestricted positive net position of $9.9 million. So overall, those two offset each other, but they cannot be used to offset each other because the business type activities are restricted in nature. It can't be used to offset those liabilities in the other funds. So overall, the unrestricted deficit is $293,000, but somewhat in the GASB world, it doesn't really paint the more accurate picture of each column by itself. Next slide. So what you can see here this is your statement of activities. So the last is your balance sheet. It's a balance at a point in time at June 30. This statement presents all activities for a full fiscal year, July 1 of 19 through June 30 of 2020, broken between governmental and business type activities. You can see that your bottom line, I usually like to go to the bottom, your change in net position on your governmental activities is essentially a reduction of your net position of $2.2 million, whereas on your business type activities, you've increased by $9.5 million. So overall, you can see expenses are $28.9 million, offset by your programmatic revenue, which is your charges for services, mainly in your business type activities, operating grants and capital of $25.2 million. So in total, citywide, $3.7 million net cost of service. We pull the general revenues in, which are your tax revenues. So you ended with a total positive change in net position of $7.3 million. Next slide. This is a view of the general fund, which we like to call the fund that remains after all other funds have been assigned or distributed. Total assets in the general fund are $8.7 million, offset by liabilities, and these will be more current focus measurement basis of accounting. So we're looking at like the next 12 months is $1.4 million. Of that balance, we have non-spendable resources in your assets of 3.9. Committed fund balance of $94,000 and unassigned fund balance of $3.3 million. And there was a table in the MD&A that kind of describes what's in that unassigned fund balance. So total fund balance is positive $7.3 million. But again, this doesn't include any long-term assets or long-term liabilities like pension and OPEB. Next slide. Overall, total revenues in the general fund for the fiscal year was $12.8 million. Expenditures were $14.8 million, and revenues over expenditures were $2 million. There was a net transfer in of 622 or almost 623,000, resulting in a net change in fund balance, a reduction of fund balance of about 1.4 million. Again, you were about 3 to 4 months into COVID in this year. Next slide. We'll go through the financial indicators and key pension information. We often like to look, this is on a government-wide basis, looking at the governmental activities and taking our net cost of services after all fees and charges on a governmental basis, including operating grants and capital grants, where that leaves you. And your net cost of services are exceeding your tax revenue in this current fiscal year. You've got $13.6 million, tax revenues of $10.3 million, not completely offsetting it. So you're using up those revenues. So you have a higher ratio of 132%. And we see that range. It can range as low as 90. On average, I see it around 110 generally. Next slide. Unassigned fund balance in the general fund. This is just looking at general fund by itself, because this is what I would call the operating fund for the city itself. A lot of activity in here. Your unassigned fund balance, which we talked about previously, is $3.3 million. But of that balance, we've got some amounts for vehicle replacement, capital accumulation, project accumulation, the operating fund, and your general fund emergency reserve. General fund emergency reserve is around 1.8 million of that number. The balance is 346 for vehicle replacement, capital accumulation 213, and project accumulation 301. Leaving an operating amount of 629,000 out of the total 3.3 million. Now, your annual expenditures for the general fund, which is mainly your public safety, et cetera, public works, is 14 and admin 14.8 million, and park and rec and community services, all the other requirements that you have. If we look at the total unassigned fund balance as compared to annual expenditures, you're at about 22%. GFOA's recommendation for reserves of annual expenditures, and this is not committed or other than for emergency reserve, is 2 months. That's not a hard and fast rule, but that'd be about 16.67%. So really, your general fund emergency reserve of 1.7 million is slightly less than that. And again, I know you've had to use up some of the reserves this year as you've been addressing COVID. But that is something to look at, because you do have replacement and accumulation funds that are sitting in there. And if we start to deplete unassigned fund balance as you're facing COVID, then it whittles away into what you really thought you had set aside or accumulated for capital and vehicle replacement. Important concept. And then we get to our pension friends. And so looking at the pension reporting standards, this is measured, and again, remember, this is measured in arrears and rolled forward to 2020 to the reporting date. So this is using your actuarial evaluation and measurement date back to 2019. So typically 2018 valuation. So you're in arrears by 2 years. And so anything that is COVID related as it impacts the pension plans, as it impacts OPEB, is not going to be reflected in these numbers. So just wanted to caveat that. So the current discount rate currently at CalPERS is 7%. You see 7.15% here. That's because the 0.15% is their administrative fee. And so they include that in their discount rate. And so that assumes that what you have under investment is earning a rate of return of 7.7%. And when you look at your miscellaneous and your safety, you're booking at that normal current discount rate of 7%. Depending upon what happens with the market and change in administration, crystal balling it, we don't know. But if the discount rate was to be dropped to 6%, your liability, as it currently is stated, of $25.5 million would go up to $39.9 million. If it went down the other direction, which I think is highly unlikely, to 8%, you would be looking at $13.6 million as opposed to $25.5 million. So you see substantial or significant change in either direction. CalPERS made several adjustments in their policy to bring it to 7%. Several years ago, as you know, in dealing with Stockton's bankruptcy, we dealt with this. And what we did is we built in a lower rate than even what the current discount rate was for our long-range financial plan. Next slide. Looking at OPEB, which is your other post-employment benefits, is their healthcare benefits. Again, same thing, looking at the sensitivity to change in the discount rate for investments, as well as their healthcare cost trend rate. You're using a really low rate of 2.2%, which is probably more reflective. It's $5.3 million. And if you were to drop that by about 1.2%, it would change slightly, $700,000 in the, higher. If you go the other direction, you're sitting at 4.7 if they were to increase the discount rate. And then if you're looking at your healthcare trend rate, you can see it moves from 5.3, 1% lower would put you at 4.5, 1% higher at 6.2. Next slide. So with all that taken into account, and I know there are many questions that you had that we addressed, and I would just like to start out to say we looked at the questions. None of these questions that have been posed, which are great, would affect our opinion on the financial statements, nor would it affect the actual financial statement as they are presented. That most of it would change something in the MD&A or in the statistical section, but those are unaudited, so it doesn't have an impact on our opinion. But this year, you've received unmodified opinions on all opinion units as described in the first paragraph, which would be the governmental activities, the enterprise or business type activities, the major funds, and then the aggregate non-remaining funds. So each of those in and of themselves and their components are presented fairly in all material respects. That means that we believe all of your accounting policies have been consistently applied and that your estimates are reasonable and that disclosures are properly reflected in the financial statements. Next slide. So our AUC 260 required communication, and we just talked about estimates, is to communicate to you anything that is significant related to the audit. And there are certain required communications. I pulled these out that are most significant. There's a several page letter that you can read in more detail. But there was a new accounting standard that we adopted as a result of COVID. The GASB responded very quickly, issued GASB Statement 95, and that delayed the implementation of other standards related to COVID, in some cases by a year, in some cases by 18 months. So the city has technically adopted that standard and taken advantage of what, this delayed implementation. We've recommended it to all of our clients because of the effort needed to implement those new standards that are coming up, such as LISA accounting, fiduciary fund accounting, are going to require a heavy lift on their part. And everybody is still trying to get used to the new normal of operation under COVID. So there's work to be done. When I say delay implementation, I would agree that we need to delay the implementation, meaning the effective date that it shows in the financials, but we should not delay working on getting them implemented. So we've talked with staff about that, and they have it on their radar. When we talk about significant estimates and disclosures in the financials, we've called those out in the letter to you specifically. Those would be your fair value of your investments, any capital asset depreciation, or the underlying method or lives associated with those capital assets. And then again, your OPEB and pension liability have significant estimation involved, including that discount rate that I talked about previously and other mortality. And there are many estimates and assumptions that go into that. We look at that as part of our audit. We look at the actuarial evaluations. We look at the assumptions that are used. We ensure that they're consistent with industry standards, as well as getting your financial statements reported, and that management hasn't changed any of those estimates from what the third-party specialist has recommended. Disclosures, there are 2 additional added disclosures in your financial statements this year, COVID-19 disclosures. They're in footnote 13 and footnote 14. Footnote 13 describes the event itself as a contingency, or what I would call an uncertainty, meaning an uncertain contingency. We do not know the impacts fully that COVID-19 is going to have on the city. You've probably had several in-depth discussions in your council meetings and in your committee meetings on that I anticipate will be monitored and ongoing. Footnote 14 describes funding that you received subsequent to year end related to the CARES Act. And so that was a required disclosure this year. Any corrected and uncorrected misstatements. If there are any uncorrected misstatements left over at the end of the audit that management deemed were immaterial individually or in the aggregate, we would be required to disclose that to you. But in this case, all adjustments were recorded and there is no unposted entries related to the audit. There were no disagreements with management as a part of the audit, where we got into discussion on the application of GAAP, generally accepted accounting principles, or auditing standards. We would be required to disclose if there were any disagreements with management. And we are pleased to know that we were able to have discussions on GAAP and application of GAAP, and we're in agreement. No significant deficiencies were identified in internal control over financial reporting. So congratulations. We do look at internal controls over financial reporting, as you would read in our opinion, for purposes of planning our audit procedures, but not for purposes of determining their effectiveness or their efficiency and whether you have efficient internal controls. But we do look at them for purposes of designing our procedures and reducing audit risk to a low enough level that we can rely on those controls. Next slide. I guess this is the thank you must pop up on a timing. So with that concludes my prepared remarks on the CAFR. I know there are other questions, and at the pleasure of the committee, we'll move forward on however you'd like on this call.
Thank you, Vanessa, and thank you, Katie. I just want to make one comment before we go to questions, and that is that I think it's an excellent document. Again, I'm sure that you're going to get the award from GFOA, and you should be proud of that. I especially was impressed with the letter of transmittal. It went into great explanation about what the city was confronted with during the fiscal year and the actions that were taken to address those difficulties, and a little bit about what it's faced in the future. And so I really appreciate that level of detail being placed in this document, because this document really is one of the few documents that has historical significance. And I think it's great that you've gone to that effort to do that. So with that, let's turn to some questions. And I appreciate you having the auditors here. This is the first time we've ever been able to talk to the auditors. This is a great treat. Let's start with Barbara. Do you have any questions, Barbara?
No, I don't. I was still reviewing some of the questions that came in, so maybe some of those, John, we might have to go through. But I had submitted some very minor points earlier to Katie, and I'm very pleased with the results as well. Thank you.
Okay, Barbara, thank you. Homer, do you have questions?
Well, actually, I have two. One for you, John. Are you planning to prepare a report that would accompany this to the City Council?
No.
Other than letting them know we reviewed it and we had a couple recommendations or whatever?
Well, I think probably Katie will put something to that effect.
Okay. My second question is unrelated, but I'd like to ask Vanessa this question, if that's possible.
Sure.
So Morro Bay avoids the same mistakes that Stockton made. In your opinion, what were several of the big mistakes that they made that created their bankruptcy?
Stockton is every city. Well, I should preface that every city is unique, and your business model is unique, and your staffing is unique. So they're not, and I worked on San Bernardino's bankruptcy, and I worked on Oxnard's distress, and I worked on City Beaumont's distress, and they're all different. So there's really, I couldn't pinpoint it to anyone. I've done plenty of presentations on Stockton, and a lot of these, and our firm is giving webinars on distressed municipalities. There are town hall meetings that are recorded, and those are online. And I've done many of those presentations with several other experts in the industry. I can make that available to the committee, which might be helpful too. But just the short answer in a short amount of time, there isn't any one thing they did wrong. There are a lot of things that they probably didn't do right or could have done better. There wasn't fraud involved, necessarily like some of the other agencies that we see in California. But I think really gaining an understanding of their total commitments, what they had committed to spend between bargaining units, they had 9. And the impacts on the pension, the pension and OPEB, I've been doing public accounting and auditing of governments for 30 years, and we just put the pension and we just put the OPEB on the balance sheet in the last 10 years or 5 years even. But everybody used to say, well, it's in the back of the book. We disclosed it, but nobody was really paying attention to the funding of those costs. And so really understanding what your outstanding commitments are on a long-term basis and preparing. They did not have a long-range financial plan at the time, and they were issuing debt, and they were projecting sales tax was going to go up and never drop without any inflationary periods in there. We all know economically that is not feasible. There's just I could go through a host of issues. One
of the big ticket items, Vanessa, and obviously you should correct me if I'm wrong, but the investment in the arena or the Neil Diamond
ticket sales, yeah, that probably wasn't the biggest issue, but the biggest issue was the OPEB. So we basically cut OPEB 100%, $541 million in outstanding potential outstanding liabilities for that current period. And we phased it out over a 2-year period. And what we found in doing that is that many of the retirees that were on our plan that wasn't being funded, we were doing pay-go, which many agencies are doing. Many of those retirees opted, because that was right when Obamacare was coming in, they opted out they were over 65, so they could get onto the Obamacare plan or into the federal for Social Security. They could get into that for their long-term health. But again, it's a costly amount. It was a huge dollar amount, and we felt that the retirees had already taken a hit. So when the bondholders came back at us and said, no, but now you need to cut their pensions too, we said we can't. We've already cut their health. So again, these are all litigatable things. I would say bankruptcy is a last resort, and if you can get people to the table sooner rather than later, and hopefully we set the stage that negotiating early is better than late, that agencies will come around. Gosh, I could talk for hours on this. But
I just wanted a couple of the key points just to let everybody
they did a pension obligation bond as well. You see in the marketplace right now, POBs are hot again. And when we did the POB, it was $140 million, and we stuck it in CalPERS, and immediately it dropped, and the value of that POB ended up being around $22 million the next year, out of that $140 million. So it really didn't change our unfunded liability. So now not only were we paying the bondholders, but we were paying CalPERS for the unfunded liability, because you put that in an investment pool and it drops substantially. So, I'm not a big proponent for POBs, but the story is you can convert your variable rate to a fixed rate, but if your investment value drops, you're not going to get credit for it in the PERS plan anyway. So,
John, that actually leads into a comment I wanted to make. That's why I asked the question about whether you were going to write a report to the city council. For the last couple of years, the city council's been, in my opinion, completely focused on the pension issue. Mm-hmm. And it hasn't talked at all about two other employee-related issues that I think they need to start paying attention to. And I realize these are both subject to collective bargaining, but they ought to be aware at least. The OPEB benefit, which I'm still trying to understand, I still don't. I don't know if you noticed in the notes, but how that it doubled, the liability doubled. And it's now, it's going so much faster than the CalPERS liability. And yet nobody's even talking about it. And the other one is the compensated leave numbers. Those are growing significantly faster than the pension liability. And now, if I understood the notes correctly, that's over $1 million now. Where 3 years ago it was like 600,000 or something. The OPEB has doubled from 2.5 to 5 million. So somehow I wish we could communicate that to the city council, that this is something that they need to be working on. Vanessa did a nice job of saying how important that was, And somewhere along the line, Katie, I'm hoping to get an explanation of how that benefit, what that benefit really is.
Yeah, I will absolutely, Homer, get that to you. My understanding is through, and just so you know, I was on the League of California Cities OPEB City Managers Task Force during my time in San Luis Obispo. So I know a little bit more than most about OPEB. I wouldn't say I'm an expert in any way, shape, or form, but I will share with you offline and to the whole committee.
Yeah, the whole committee would probably be interested. I don't know. Does everybody in the committee understand what that benefit is?
So let me just explain as best as I can now, and then I will add on to that understanding. So the city gets its health insurance through CalPERS, and CalPERS requires the city to pay a minimum amount for every retiree and every active employee, which is about $150 a month right now, to afford retirees the opportunity to buy in on their own behalf. So the city does not offer retiree medical the same way that, as an example, Stockton does or the city of Culver City does. There's a number of cities that pay 100% of a retiree's health insurance cost. But for the city of Morro Bay, we pay the minimum amount feasible for both our retirees and our active employees. And then for our active employees, we pay whatever the cafeteria plan contribution is for our active employees, which is negotiated with our bargaining groups. So for retirees, just to be perfectly clear, we don't pay if it was $800 for a single person, the city is obligated to pay $148, I believe is what the contribution is now. And the retiree is required to pay the difference, the $650 difference between what it actually costs to get the health insurance and what the city's minimum payment is. The reason that OPEB has increased as much as it is because, and this I'm going to turn to either Sandy or Vanessa or Catherine to explain it, but the imputed value of that benefit is calculated at the $800 level, even though the city's not required to pay that $800. So it is I'll call it an assumptive calculation, an actuarial calculation based on the imputed value to the employee, even though the city's not covering the expense of that. And so I'm going to leave it there because I see many blank stares in front of me. So I'm going to do my best to find a really good explanation, and it might be on the League's or the Institute of Local Governments site. And Vanessa and Kathy, if you have any great resources, I'd be loving you to share them with us, just so that at the end of the day, I don't confuse matters more.
Hey, Katie, if we could get a copy of that actuarial evaluation that was done for June 30th of 2020, if you have to omit the information about the employees, that's fine, as long as there is some kind of a totalized information or summarized information. But I imagine that this is explained somewhere in that document is exactly how the benefit is calculated.
Yeah.
And if we could take a look at that ourselves, I think we'd all understand it better.
Yeah, and I did inquire with the city clerk before the meeting, and so that's why the answer in the list of questions is the way it is, which says I'm exploring to make sure that I don't violate any privacy laws. So yes, the short answer is yes.
So,
Okay, and then Homer, I think if you have a chance to read that, you'll understand it better, and so will I.
okay, I just have one quick question. So in other words, if somebody retires at 58, the city continues to pay the $150 a month until they're 65? And then what happened? And then they click onto Medicare, and does something explain that?
I will look into that, Homer. I don't know that level of detail, so I will look into that when they get to.
Katie, Tina, clarifying question. So the actuarial rate, like the 800 in this example, versus the 150 obligation, when we're looking at the financials, we're seeing those totals are based on the 800. Is that what you're saying?
I believe that's correct.
Okay. I just wanted to make sure I understood what you said, even though I know we're waiting for further, information, but I just wanted to make sure I understood what you said. Okay.
Vanessa, if you care to correct anything that I've said, please feel free.
Yeah, I wanted to, I thought it might be helpful just to turn your attention, if you have your CAFRs, to page 84. And this is where Homer is seeing that the liability doubled. I don't know if you can see that.
That's why I spent a lot of time on page 84.
Okay, so the right-hand column is the number you're booking at, and you can see within there, it started at 2.8 million and it went up, and the largest change in there is change of assumptions, right?
Yep.
See 2.8. So I took the liberty to go back and look at your actuarial valuation report that we were given by your third-party expert. And in one of the pages, which is page 23, there was an interest rate assumption changed. So where we were describing in that slide earlier that I presented on OPEB, the 2.2%, they changed your assumption on your interest rate from 3.5 to 2.2.
Yeah.
And it says assumed rates of retirement, termination, and mortality have been updated to align with those currently being used by statewide pension systems, and an applied rate subsidy is included. So your actuary went back. So I would say probably mortality, termination, rates of retirement, and that discount rate change is resulting in that 2.8 million, which will be amortized out. And I looked at the back report. It's going to be amortized out over 9.7 years. So you're going to get a hit of that amortization of about $300,000 a year into pension expense related to that item.
Okay. And Vanessa, I think the reason why the discount rate was reduced is because the money has not been set aside into an irrevocable trust. And so they're not able to use the CalPERS discount rate. If the money were in an irrevocable trust, they could actually use a higher discount rate.
Correct. You're not in
really reduced. But the
Correct.
city council has not chosen to fence off that money in that way. The money actually is still accessible by the city council to be used for other things. It is not in an irrevocable trust.
In a 115 trust. And again, that again, decision making is 2020, hindsight's 2020, and I hate to say that, it's kind of overused these days, but you might need to access that money with everything going on with COVID. So when you set it aside, you don't get to access it.
Right.
Yeah.
Okay, so Homer, are you done with your questions?
Yeah.
Okay.
I didn't waste too much time. Sorry, John.
No, you're good. Okay, Bart, how about you?
I'm just, most of those questions, I presume, John, came from you, and they were characterized as being not pertinent to the audit and therefore don't change anything. Assuming those primarily were from you, is that the characterization that you think is appropriate?
Yes. I mean, a lot of those things I think would have been discussed at the subcommittee level if we had a subcommittee this year, but we didn't. So this is like the one chance to do it. Didn't expect anything to change in the CAFR. I mean, it is what it is. It's done. Just some things to be aware of for next year. I do have a few questions that I presented that I think should be asked of the auditor, and I would like to ask those at the end after everybody else has a chance. I think maybe 3 or 4 questions.
Sure.
So, Bart, anything else then?
That was all. Thank you.
Okay, thank you. Let's see, Lois?
I just want to second the information in the transmittal letter as being very helpful, and to express my appreciation to Sandra and the rest of the team. I know that's a lot of effort, especially right now, and thank you. You did a good job.
Thank you, Lois. Appreciate that. And Tina, any questions?
No, thank you.
No? Okay. Steve?
I appreciate the detailed work that the rest of the committee did. I got the CAFR on Friday, so I did what I could to sort of figure out, if I was reading it as a layperson, what would some questions pop up. And one of them had to do with when the emergency reserve is being described, there's a resolution that's contained in there. I think it sort of pulled out some inconsistencies about how we look at the general fund reserve, and I thought the committee did an excellent job of analyzing that last year and saw the response. There were a couple items that I just wanted to emphasize. One was there was a categorization of community enhancement or community promotion in some of the line items. And it was the only one that didn't seem to be a departmental description. We had fire and police and public works. And then there was kind of community promotion. And I assume that means community development and maybe TBID, but I don't know. And I think I'm pretty familiar with the city's budget, but I sort of couldn't translate between what was intended to be covered in the audit or the CAFR and what was described in the budget. So I'd like some explanation of what those numbers represent. And maybe it's community development, maybe it's not. And then there was some sort of interchangeable use of public works and public services. And there used to be a public services department, but there isn't anymore. So if I'm trying to translate between the budget and the CAFR and kind of what really goes on in the real world, I had difficulty there. And then I had some questions about the harbor fund. And I don't think that's an auditing issue. I think that's a management issue that, as you can tell by the CAFR, it's upside down. It's in serious trouble. And I thought that there needed to be some attention in the management letter that says that's going to be addressed. But maybe that's a financial plan issue that we're going to be dealing with over the next 6 months. But it's an issue that ought to be called out more prominently than it is in this document.
Thank you, Steve. Katie, do you want to address any of those now, or do you want to get back with Steve later, or how would you like to do that?
I'd like to suggest if Vanessa and Kathy can address the question of categorization of the community promotions versus community development and that piece of it, because that is something that is, I think, within the scope of the audit of those expenses being doled to those categories. And then I'll get to the other question about the harbor fund for sure.
And I don't know if we want to start with Sandy on the coding, because some of it's direct coded to community promotion, in the general fund and then in the other non-major governmental funds. But, and then we have housing. So I want to separate community development from housing for purposes of call. Sandy, you want to?
I think that for purposes of our purposes, we totally get the difference between community development and housing, but I'm with you, Steve, about there is no community development categorization. And so there is a community promotions. It's a non-major fund within the general fund, but then it doesn't call out community development. So if it needs to get looked at and get back to Steve on it, we can certainly do that in retrospect. I think maybe that's the best approach. Because I think that from Sandy's perspective, and Sandy, you can speak for yourself, but at least the way I understood it, it was how it was and historically has been presented during the time that the Poon Group has been doing the audit.
I'm not remembering what page that line is on. I don't know if Stephen could tell me what page he's looking at. But yeah, historically, that's a term that was used in the CAFR only. I don't know who identified it that, but typically I would have to go back and double check the roll-ups, so I don't want to misspeak it, but I'm generally feeling like it's community development, tourism, and possibly a housing fund.
So it starts on page, the statement of revenue and expenditures. And it could be that if the city has historically looked at that as being this collection of departments, then a footnote would be helpful. It just doesn't comport with, if I'm looking at the expenditures, there's administration, finance, fire, housing, police, public works, recreation, and parks. And this community promotion thing is the only one that doesn't align with a department, with community development being planning and building. Housing, I think, is somewhat separate I think it's a different impact fee or CDBG. But from a reader standpoint, I'm not saying go back and correct every page. I'm saying let's footnote this so the reader knows what dollars are associated with what activity.
Are you on page 24?
Yeah, and just to, I was looking at it actually on the governmental funds themselves on page 33, because that's where the bulk of it is at, 1.4 million, and some of that, about 500,000 of that is your TBID. So tourism is in there, so that may be why promotion got attached to it. Because it was a tourism accumulation fund, and it could have come out of that legislation or that formation of the TBID. I'd have to go back and look historically at that to see if that's why we picked it up in that area. And then 871,000 is general fund. And that may be some of the more community development based activity. So it may be that it's a combo of the tourism plus the community promotion, and it doesn't hurt to have a separate line for tourism, but it probably got lumped into that community promotion. But it could be, we could always call that community development and tourism. Would not be a bad name since it's both.
Well, again, let me double check it, because the tourism fund is a non-major fund. That's in the non-majors. So I would just have to go back and check the roll-up on what, because for financial statement purposes presenting, many are grouped together. But is there any reason why we couldn't change that title from community promotion to, this is a format I inherited, so I don't typically just go arbitrarily and change titles. And I am asking the auditors of that, because this is kind of embedded in the financial statement.
In the budget book, do you break out TBID from community development? I don't have it on me. You do?
Yes.
So maybe that is something to look at. It doesn't change the nature of it, but it could be that you have two lines there instead of one. So you have community development on one and, tourism on another, which tourism will be probably under the radar for 2021, right?
Yeah, it won't be material, I don't think.
Yeah. So
why don't we noodle through that offline, Steve?
Right.
It's this is one of the great things about having new perspectives and a new set of eyes come and look at something, because just because we've done it this way for ever and a day, obviously being more clear about it is a good thing, at least from my perspective. And it's not a reflection on the work that's been done in the past. It's just how do we continuously improve?
Agree.
Okay, thank you. Okay, so I did have a few questions for the auditor, and thank you for the opportunity. On page 62, there's a discussion of how the fund balances are categorized or characterized, and one of the ways to characterize them is as committed. Mm-hmm. And it says that committed fund balances are self-imposed limitations by the highest level of decision-making authority, namely the City Council. So I'm pretty sure that the City Council decided that there would be these set-asides for vehicle replacement, capital accumulation, project accumulation, and opportunity fund. And they actually specified how much money was to be put into those pots. And so I'm wondering, and I see Scott Collins is online as well, I'm wondering, from the auditor's perspective, why would those not be considered committed?
would it, and I'd have to go back and look at the original reso on there. Is it something that they've delegated authority for changing that to city manager?
I don't know.
And the funding of it?
There's a broad authority to make changes, obviously, in emergency situations that we find ourselves in with COVID-19. I think that threw everything out, including our general fund reserve levels that we're trying to hit. So I think committed maybe takes on a legal term when it's related to the audit, and that, no matter what, city council can't touch it, or it only can be used for that thing. This is a discretionary matter for council established by council policy that can be changed at any time. I think that's sort of how we look at it. But ultimately, John, you're right. At the time that those policies were created, we're trying to spread more of the funding into those funds that had typically been brought down to zero, close to, just to balance the budget over the last decade or so.
Okay, and the reason I'm asking is because now we're being told in one of the responses that the monies that are in those categories or in those pots is also considered part of the general fund emergency reserves. So it's almost like the same money is being used for two different designations. And I just don't understand how that can be done.
So could I just respond to that? Because as you can tell from the note that we included in the responses to questions, it appears from everything that I've been able to decipher in the last 90 days that this is a historical practice that the previous finance directors have instituted. So while it's more transparent now, it's not a change in practice. And again, it's based on the fact that by council policy change, those dollars could be used for any purpose within the general fund. So historically, that has been the definition of it. It may be something that, is different than, at least I've seen it be presented the exact same way to CFAC as it was to the council. And so just historically, that is the way that it's been done. You could agree to disagree about whether that was a good practice or a bad practice, but that is the way it's been done over the course of the last number of years.
Well, I think that's something that at least the city council should be aware of, the fact that that money is being counted for both things, or for, I should say, all five things, because there's actually 4 different pots plus the GFER. So at least the city council should be aware of the fact that money is being shown in both places, so to speak. And then they can decide what they want to do. If they want to just say, well, it should all be general fund emergency reserve, then they probably should zero out the other accounts. But okay, for the auditor, did you review the GFOA comments from the 2019 report?
We did.
Okay. And they had a comment in there about transfers, and I just want to read it. It says, reimbursements should not be displayed in the financial statements as transfers. The disclosure makes it appear as though reimbursements are reported as transfers. Reimbursements should be treated as a reduction to the originally booked expenditure, and therefore would not be reported as an item in the external financial statements. And then they made the same comment 2 years in a row, because after the first year, the city didn't change that note and didn't, I guess, make a response. So they reiterated the same comment. And I just wondered if you had an opinion about what they're saying and how is the city supposed to address that comment?
And are they, how did they determine that it was a reimbursement? Are they just suggesting possibly you have reimbursements? That's what I couldn't gather from the comment. Unless they're saying, general fund is getting or water and sewer or whatever is getting reimbursed or something like that from the general fund or vice versa. But typically, I would think, and you don't have a ton of transfers. I mean, we do have a lot from water and sewer, right? But I would think we could have we changed, I think, the footnote to fix that. And that last year we had talked about it being a reimbursement. So this year, when you look at the transfer, it doesn't refer to the reimbursement as opposed to paying for administrative services provided to other funds.
Okay, so it's just really that word reimbursement that they're.
I think that's what they got knotted up on. Mm-hmm.
Okay, nobody actually talked to them about what they were trying to address there?
Yeah, no.
No, okay. As far as transfers, one of the odd things about that table on page 67 is it shows this $1,483,000 going from the general fund to the general fund. Shouldn't that be washed?
Netted, yes.
Netted, yeah.
And that would be the only number change, but it doesn't change any of the bottom line or the opinion. So I talked with Katie about that. And any of the others where we had differences. I mean, the option is at the pleasure of the committee and management, as it's your report. So, I'm standing by if you think that is worth the change to fix that.
I don't think so. I think this is just for next year. Yeah.
We should have caught that, and we were trying to, get the report out, and sometimes it goes through. We have 3 partners review this report, so we should have looked at the transfer table closer. But yeah, we didn't catch it. But it was a between the roll up of the funds. Yeah.
Okay. All right. And then
my apologies on that.
No problem. Have you already issued your report on internal controls?
We have not.
Well, you have not. Oh, okay.
I don't think so. I don't think we put it in this packet, right, Kitty?
No.
But we know we've looked at the test work enough to conclude that we would not have any findings that would rise to a reportable condition level.
Okay, but that's something that you will be providing. I imagine, Katie, you can just forward that to the committee when it's available.
I will. And I think it's stated it. So in either my email or the transmittal, I forget which.
Okay.
Yeah, it'll be part of the single audit. We bind it into the single audit for the federal awards.
Okay. As far as the page that shows the general fund budget to actual, is that a table that the auditor puts together?
We do, but we put it together with management, but yes.
Okay, so I think you might want to take another look at that one, because it doesn't, just the budget part of it just doesn't look right. But. Yeah,
the transfer out should have a negative around it. We saw that. We need to correct that, and then that would update the MD&A.
Okay.
So it's unaudited, but we do need to fix it. And then I didn't know the response on whether the final budget went to council. I think Katie responded on that one.
And that's something that, the city has gotten into this practice of amending the budget after the fiscal year is over. So like in October of 2020, there was a final budget amendment for the fiscal year that ended. Mm-hmm. And you're getting all that information, right? You're getting the original budget, the mid-year review, and then this post. Yeah. Fiscal
and I even have some clients that do a final budget amendment with the CAFR in the event that they have to move stuff around. I've had that in the past. We don't like that, but we have had that.
Okay. Now, as far as I know, the city doesn't actually publish a final budget per se after that last budget amendment. Is that a practice that you would recommend they do?
No, normally we would rely on your budgetary system. So every time a budget amendment is made, it gets entered, and we look at that as part of the internal controls to ensure that budget amendments are getting posted and that they're not in arrears or late posting, so that when we pull the data from the system, it's reliable for the final budget. That's the typical practice. is that you can see it. And a lot of cities are moving to, as you know, OpenGov, where you can see real-time budget information that draws from OpenGov.
Okay, but you still end up with this odd situation that you have a new budget now that shows last year's budget, and then the budget changes. And
in the budget book?
Yeah.
Yeah.
And then that never gets changed. And
yeah.
so there's...
Yeah, so the budget book is going to lag. The budget book is going to lag because it's going to have its final budget and then projected actual, right, for the year. And so that final budget that was in the budget book, fund by fund, is going to lag possibly the October amendment, right? That'll be in this book.
Yeah.
That's common.
And that's one of the things that's difficult about this whole accounting thing is that the numbers presented in the budget are presented in such a different way from what's presented in the CAFR. And any efforts that could be made to try to match those up, as Steve was pointing out, sometimes the descriptions and the categories are so different in the way the numbers are assembled that there's no way to really compare the budget document and the CAFR. And I think the city could maybe take a look at that and try to keep that in mind.
And the
CAFR has certain formats that it wants to have, but in as much as the city could try to match them up, it would be helpful.
Yeah, the GASB is redoing GASB 34, and I sat on a hearing for it, and with Ken Poon, the partner, in looking at whether the usefulness of the CAFR and GASB, kind of a historical look back. And I don't know that I would, having been on the CFO side, would ever use the CAFR for budget analysis. I would rely on the budget folks versus this document. And again, you got to reconcile encumbrances and show all your differences. It's an ideal world to have been able to reconcile between the two. And I commented in that hearing specifically that we need to decide as auditors and publishers of financial statement information whether the CAFR is it trying to be too much for too many people as opposed to, an annual report or a budget document? Are we trying to incorporate too much into the CAFR? And so I posed a question to the standard setters, but I don't know.
One last question for you, and this is something I brought up to the committee and management a couple of years straight, and that is that the GFOA recommends that municipalities create an ad hoc audit committee that, per the Brown Act, can actually meet with the auditor behind closed doors. Is that something that you would recommend the city do?
So audit committees are always useful if you can to enable and ensure two-way communication at a much lower level than a full city council. In Stockton, I had an audit committee and it had a charter. It was sorely outdated, but we updated that. And when we say outside of public view, you still, under Roberts, you cannot have a quorum. And so we had, I think, 5 members on the committee. No, we had 3 members on the committee, something like that, 3 to 5. And so we would only meet with them one-on-one. But as an auditor, we would meet with the audit committee members one-on-one and walk through the CAFR. I think there's a good exchange of information, and maybe they have a better understanding of the financial report from city council serving on that committee because it's more detailed and we spend the time with them. It isn't a bad idea from an oversight perspective. Again, I know during the bankruptcy, we essentially abandoned that process because we wanted 100% transparency. And so whatever we communicated to the audit committee was communicated equally to the council. So normally, an audit committee would serve the purpose of hearing the report and seeing it and then recommending it go to city council, and then it goes to city council as consent. We did not allow the CAFRs to go to city council as consent during the bankruptcy process. They went as new business. Okay.
Well, I appreciate that response. I mean, one of the benefits, I think, of the audit committee is that, unfortunately, some auditors, and you've been very free with us today, and I appreciate that. But typically, auditors during a city council meeting will not accentuate the bad news, and they also won't be very candid, or sometimes will shy away from that. And whereas in a closed session ad hoc audit committee, they can just lay it all out there.
That is correct.
So, yeah. So
may I also add something, John?
Yes.
So I actually asked Sandy previously if the auditors meet with the mayor and the mayor pro tem, because that's my understanding, that's my experience in other cities, is that once, if it goes to a committee, then that's where this level of detail happens, but then without staff, so they start with staff takes its leave, and then they get some private time. That makes it sound terrible, but that's not what I mean. They get some dedicated time with the mayor and the mayor pro tem so that they can share any particular concerns that they have about staff, right? Or kudos to staff, or whatever they have to say outside of staff's presence. And so personally, I would advocate that that's the right level for that conversation to be had at, because that's where something can happen about it. I recognize that that's all of your intent is to make positive change, but at the end of the day, the council has the responsibility, both from a policy perspective and a fiduciary responsibility, to make those changes and to hear that information directly from the auditors.
Thank you. And Vanessa, you mentioned that it wasn't the case with the city of Stockton, but there actually were some water districts that had some fraud going on. And, having an audit committee probably would have gone a great length to stop that.
City of Bell is our current client.
The City of Bell too, yeah.
City of Bell, but we took them over after they got better.
So
we do. I just wanted to mention we do oftentimes do in-person interviews for SAS 99 or Zoom. Now that it's our SAS 99 is our statement on auditing standards for fraud. We often do one-on-one meetings with members of the City Council, and often it's the mayor or the chair of the audit committee, or like the chair of this committee, as long as they're in that standard, governance structure. And we often do have candid conversations as it relates to fraud, controls over fraud, education over fraud, policies over fraud. And we go through the whole thing as it relates to that. And then sometimes there are other discussions of, we ask, are there areas of the organization you'd like us to look at? And management typically does not sit in on those meetings. So we can still kind of accommodate that, but do it in a less formal fashion in a smaller agency.
And I'm not casting aspersions on anybody here. I think everything is above board here.
Yeah.
It's something it's preventative.
Yes.
Is what it is.
Yes.
Okay, those are all the questions I had. Are there any, did I get everybody? Okay, are there any public comments or questions? Okay,
Sorry, sir,
Zeke,
at this time, there's nobody with their hand raised.
Nobody, okay, very good. Well then, I guess we need to take a motion and a second and a vote to approve or receive and approve this to go to City Council. Do I hear a motion?
I'll do it. I'll so motion.
Okay, how about Tina moves and Lois second? Is that okay?
I guess so. We're jinxed.
Okay. All right. So all those in favor?
Aye.
Aye. Any opposed? Hearing none, the motion passes 7-0. Hey, Vanessa, thank you so much for attending our meeting. This was, I really got a lot out of this. I hope everybody else did. I don't know if we'll be able to do this every year, but it sure was nice to have it this year. Thank you.
Great. I'm pleased to be here and have the conversation, and I'm glad that you guys are reading the report. it makes us happy because we spend a lot of time and a lot of effort on it. So, I mean, it's a lot. So I really do appreciate the dialogue. I think it's important for our constituents as well and the citizens.
Thank you.
And John, may I just add and have the last word to really publicly thank Sandy for all the hard work that she's done. I mean, it has been tireless and relentless and any other adjective that you can figure out. She's been incredibly professional and helpful and above and beyond on behalf of the citizens and residents of Morro Bay. And the transition between the Poon Group's transition and my transition in has really been an extra level of effort that has been required of Sandy. And I just want to express not only my personal appreciation, but I think I speak for Scott and the rest of staff in the finance department and in HR, how much her work has really made a difference in making this presentation happen.
Amen to that. Thank you, Sandy. And I believe, Katie, are you going out to solicit bids for auditors next year?
Yes, that's correct. We had a 5-year contract with an extension, and I believe that the last extension is the current work that's being done. And so we will be going out sometime in the next few months.
Okay, thank you. Okay, next item.
Thank you, Vanessa. And
okay, thank you. Thanks, everyone. Have a great day.
Thank you. You too.
John, process check with
Sure.
25 minutes to go to your target time.
Yeah.
Either we need to know we're going to go over, which can work.
Well, let's
put off the PERS discussion.
Yeah, let me just see if we can, on this next item, this is the PowerPoint presentation for the Measure Q, which was attached to the agenda. And I just used Barbara's template from last year and updated the numbers. Did that look okay to everybody, or are there any corrections on that, or is that okay to go to City Council the way it is?
I thought it was great. Go.
Thanks. I also, John, looked at it carefully. It looked pretty good. I didn't see anything,
Okay, so we don't need to spend much time on this item then, right?
No, I don't think so. It was covered adequately.
We reviewed all the numbers last month, so. Okay, is there any public comment on item B2, presentation of the Measure Q to the City Council?
No, sir, not at this time.
Okay, so we'll move on to the next item.
John, I did have one observation, which will come up with the budget, but the storm drain issue is part of Measure Q. As best I can understand, and the response I got back from Katie, it appears that there is no plan to ever address storm drains. There are lists of $7 million, $14 million worth of work that probably needs to be done. But as the reason I bring it up here is that theoretically, more than theoretically, that was supposed to be part of how Measure Q funds were to be spent, and it's been ignored. So it might be a future agenda item as to what's going to be done with storm drains. And it's right now the plan is do nothing and let them fail and fix them if they fail. But that is the current plan, since we're not using any Measure Q funds. Not that it would put a dent in what's needed, but that is fundamentally where we are with storm drains, as best I can gather.
Right, and the report that's going to the council does show that $0 were spent on storm drains during the fiscal year, so they will see that very clearly.
It's more than fiscal year, John. It's literally since the passage of Measure Q.
Right.
It has been ignored, and when I bring this up every year, I don't want to say it's ignored. It's thought about and dispensed. So the council is making the decision that they're willing to take the risk of any failures because that's not, as I understand, part of any 218. Sewer and water were, and so it's just not there. So it's not a matter of this fiscal year. It's just, the decision is implicitly being made, let's let storm drains fail, because the alternative would be, let's put it for a 218 vote or figure out a way to fund it.
Yeah. Well, and I think, our job is to make sure, or not to make sure, but to just track how the money was spent and report to the city council and report whether or not it was actually spent on the things that were listed or mentioned during the campaign when Measure Q was approved by the voters. And we do that. And of course, there wasn't anything in the measure that said X amount had to be spent on police and X amount had to be spent on fire and X amount had to be spent on paving. As long as it is spent on those things and not on other things, then I think it's legitimate. It's up to the city council to prioritize among those things how the money gets spent. And I understand it's disappointing that nothing got spent on storm drains, but really our only role is to report to them that fact and leave the decision up to them. So next item, second quarter investment report. Katie. Oh, you're on mute still, Katie.
Thank you, Mr. Chairman. The information is before you. It's not substantially different from the results that we received in the first quarter. Staff is still recommending that we stay the course because of the funding necessary for the WRF, and staff is prepared to receive any feedback that the committee has.
Okay, thank you. Yeah, it looks good. That's the first time I've seen where the city actually beat the LAIF rate, even though they're both pretty dismal. But at least you did. And the amount you're keeping in your current accounts looks like it's gone down quite a bit. It's just a little over $6 million, I think. So that was an improvement. Any comments or questions from anybody on the committee?
Just to Sandy, thank you for moving $5 million from the demand deposit accounts into the LEAF account.
That had to do with a bank account. I think it was with Opus. They were sold to Pacific Premier, and they dropped their interest rate dramatically. So we closed out the account and moved it to LAIF.
Well, thank you for moving it.
You're welcome.
Take credit for it.
I will take credit. I get so little of it.
Well, the amounts that you have in Mechanics Bank actually is quite a bit less than last quarter also. And
yes, I have been moving money where appropriate.
Okay, anybody else? No? Okay, any public comments or questions on this item?
No, sir, Chair. There is nobody at this time.
Okay, thank you. Let's, so we just receive and file that one. I don't think we typically take a motion on that, right? We just go on from there. Okay. Item 4, presentation on California Public Employees Retirement System. Katie.
So I did my best to summarize the information about an extraordinarily complex topic. The city has reviewed this topic. The city council has reviewed this topic a number of times in the past, and most recently when they developed a plan to pay off some of the unfunded liabilities. I don't think it would be worth the committee's time today, particularly given the constraints on time, for me to give a long presentation about the different plans that the city has and the different tiers that we have and the work that has been done historically to address the unfunded liability. unless the committee wants me to do that. I just worry about the amount of time and attention that might take away from what was intended to be a primer, if you will, on the topic. I can tell you that the PERS system is not meeting its discount rate objectives. And so I would anticipate that at some point in the near future, they're going to lower their discount rate. One of the things that Vanessa said that has always given me concern is that when you give PERS your money to pay off unfunded liabilities, you run the risk that they're going to lose money, and compared to the discount rate, or they're not going to achieve the short-term discount rate in terms of their portfolio, and your unfunded liability has the risk of going up. And so you'll see in the actuarial analyses that are provided by PERS that even when we pay off some of the unfunded liability, it goes back up when they aren't meeting their discount rate concerns. And so I know this is a major conversation for the future as it relates to how we're going to fund the WRF and if there's cash that's going to be available. And I don't want to get into that topic because it's not specifically on the CFAC's agenda for today. But this is intended to be a basic overview of our pension system, and I would be happy to take feedback about the information that's provided and additional questions that you'd like us to explore, and that we can come back with that information in the future.
Okay, Katie, thank you. Well, let's go to the committee members. I think, Homer, aren't you kind of the person who kind of get this going and asked to have it on the agenda or start the conversation?
I was, but this was not my idea. The idea of using borrowed money from the WRF project to pay down the unfunded liabilities. It was actually an idea that Jennifer Calloway gave me. And the future agenda item that I listed last meeting, I was just curious to find out, either from Mr. Collins or you, Katie, when you thought that might appear on our agenda to talk about, and if we'll talk about that before the City Council talks about it.
I guess I missed, where did this discussion come up about some relationship between WRF funding and the pension liability issue?
Well, Ms. Collins,
what's the connection?
The connection is that, and I don't understand this, and this is why the reason for the future agenda item. Jennifer told me that the city pays CalPERS 7% interest on some amount of money every year. And we're borrowing money at a blended rate at about 1%, should end up about 1%. So her position was, should we go ahead and maximize the borrowing for the WRF and related infrastructure projects, and take the $10 million in cash that the city's currently sitting on in the harbor and water and sewer fund, and pay down the unfunded liability, and then have the general fund and the harbor funds pay back the water and sewer funds at a LIFA rate or something like that for the $10 million. And her position was, at the time, it was saving a lot of money. And my future agenda item at the last meeting was to try to get a lot of detail about that, to find out if it even makes sense to even talk about it. Obviously, it'll be a major conversation with the City Council and the community.
Right.
But it makes a lot of sense to use 1% money to pay 7% money off. Correct, Bart?
Yeah.
This is a very interesting discussion. Clearly, that would apply to all of basically, the city's already, my term, robbing the infrastructure money's collected to pay it down. And I don't see how you take money from sewer and water, their funds, and different funds, and use them for the general fund.
I'm going to hop in because I think we're getting into the substance of the question. My recollection is that we committed at the last meeting to come to CFAC before we go to the city council and get the CFAC's recommendation to the council about that question. And so I understand everybody's there's a desire for more information.
A lot more.
And a perspective that they may have already, but the intent is to come back to CFAC before we go to council with that financing plan. And we think that that's going to come somewhere between March and May. And I don't have the CFAC's calendar off the top of my head. And so if we have to have a special meeting, we will, in order to be able to facilitate the conversation before the recommendation goes to the council.
Yes.
We have meetings in April and May.
Yeah, and Katie, just to add on, Chair Martin asked us to bring back a primer on CalPERS, and that's what we've done. So this is not the discussion that Homer's talking about because we're not there yet.
That was a separate action of a 4-part staff report, as I recall from last meeting.
Yeah, so this is just to provide kind of a primer, and we borrowed heavily from the last time we provided the update to City Council because Ms. Lichtig and Sandy were working over the holidays to get the CAFR done. So this was our best shot to get something in front of the committee, and we recognize it's not fully complete, but given the circumstances, I think we've done what we can to get you some good information to start the ball rolling in case CFAC feels there is something to this idea that Homer is discussed, but that's not the subject of this discussion right now.
Right. So the questions about should be limited.
Yeah.
Yeah.
What Scott just said is what I understood this discussion to be about. I really missed. Okay, that's what was presented, and what Scott said is what I thought this was about. Homer took this into what I think is a whole different direction that has. That I was not aware that was being considered since there's so many other factors. I am interested in how we maximize this low interest money. I'm absolutely supportive of that.
Right.
Okay. And thank you, Bart.
And just one more time to reiterate, so that the discussion we had the last meeting was sort of the general more oversight, financial oversight. And one of those big questions that this team is being asked to do is provide a recommendation to council about sort of the blending of our how we finance the war. And depending on how that comes together, depending on the interest rate by the SRF and a number of factors that would come to you sometime between March and May, there is maybe latitude to either allow for more financing of other water projects, or potentially this idea that Homer has discussed, which is other funds borrowing from that. We did outline that a little bit, but not to the degree that we just discussed, that Homer just brought up. Again, we don't want to go into that because that's very complicated, but it's just, that could be one of the recommendations that comes from this committee. So again, because that was brought up, we wanted to bring it back to, okay, so let's get a primer on CalPERS before we would jump into that conversation. Again, that would be just one of several recommendations that could come from this committee. So sorry.
Thank you, Scott.
Belabor that. Yeah.
Lois, did you have a question or comment on this?
Yeah, I just want to redress the issue of funding the liability because, I think that there's still a benefit of paying down some of the unfunded liability recognizing that there's risk. And I hope that we can get some more clarity about why we want to still do that.
And I can, when we have that conversation, I can certainly provide the pros and cons associated with it. And it will be a comprehensive analysis for sure.
Okay. Tina, do you have any questions?
Sorry, I didn't unmute quickly. No, thank you. I'm interested, and I'm looking forward to that discussion that we've now spoken of again in great detail. So
okay.
Sometime between March and May.
Okay, thank you. And Steve?
I don't have anything to add, Mr. Chairman.
Okay. Barbara?
No, thank you for the very comprehensive primer, Katie and Sandy. I agree. That's the first start, fully understanding that.
Thank you. So, Bart, did you have any more comments, Bart, or were you done?
I'm good.
Okay, thank you. I just had two things, and one was in regards to the prepayment that the city made in the last fiscal year, $486,000, and it was to pay down the Tier 2 and the PEPRA unfunded liability. And what was interesting about that is that it came out of the general fund, but it benefited all the funds. It benefited the general fund and water and sewer and harbor, which those three are enterprise funds. They should be self-standing. And here we're talking about coming up with an idea of using enterprise funds in a way to benefit the general fund. Well, what happened last year was just the opposite. The general fund ended up benefiting the enterprise fund, which is perfectly legal. General fund can do that. But other than the harbor fund, it seems to me that the general fund is the one that is in the most financial distress. So I definitely, whatever the city does, I recommend they don't do that again. You know, there are ways to accelerate payments to CalPERS without doing lump sum payments. And if the city wants to accelerate that, there are ways to do it individually on each of the 9 plans. So that was the only comment that I had. Are there any public comments or questions on this?
No, sir, not at this time.
No. Okay. Well, then that concludes this item. And the next item is future agenda items. What do we have for the February meeting, Katie?
Let me pull up my list because my memory doesn't always serve me, but I made a list. Okay. The FY 2021 mid-year budget, input to the council on the 21-22 budget goals, not goals totality, but the council decided to focus on whether we should add a COVID-19 recovery goal specifically. And the 2021 WRF quarterly report, according to the schedule that you adopted in December.
Okay, so that sounds like a pretty full agenda also. And that meeting will be on February 16th at 3 p.m.
Will the discussion on the 21-22 budget be kind of a general comment period about the budget and just in general for us?
No, that wasn't what I anticipated based on the feedback that we got from the city council, based on the budget process that they wanted to pursue. Let me just go back and talk to Scott, and then we can circle back with John about it.
What specifically kind of interested in is how we're going to, how the city's going to account for and manage Measure E.
And that's a great observation, Homer. My understanding is that we will be addressing that as we move forward. I think that there's an expectation that CFAC will be incorporating that within your portfolio, just as it is with Measure Q. But let me get back to the committee as a whole and talk to Scott and then also talk to the chair. And then we can figure out if that's the most appropriate timing, or we could do that at a future meeting. But the three things that we have on the calendar are time sensitive in terms of we've made a commitment to come back to you 2 months after the close of the quarter. And then the other two are dependent on particularly the mid-year budget, which is supposed to go to the city council the next week.
Okay, and Katie, next month, you're also going to have the 10-year forecast and the budget calendar. Is that right?
The budget calendar is going to the city council next week based on the feedback that they gave us at the last city council meeting. And yes, the forecast, I even though I made a list, it wasn't on there. So yes.
Okay. Well, that, I think, does it. So it is 5 o'clock exactly. We are adjourned. Thank you, everybody.
Thank you.
Good job, John.
Thank you.
Thank you.